Hello, hello. It is 5:20 p.m. October 25th, Tuesday, for the post-market um, recap and review. Looking at the economic calendar, basically we only had one real major market impacting data released today, and that was the consumer confidence report, coming out below forecast and below the previous, showing signs of a weak consumer or a fearful consumer. And this comes to no surprise to me, as inflation is hot, credit card debt is high, people's mortgage payments are getting higher and higher every month. Um, there's a bunch of different factors that are adding pressure to the everyday consumer, and this is showing with the October report here coming out pretty bad, like very, very bad, much worse than forecast. And this, of course, as stated in this morning's analysis, any bad data point here is actually positive for the stock markets, as every single stock market, the U.S. stock market, U.S. 30, U.S. 500, NASDAQ, all closing sharply higher. And this is because of the unique economic landscape, that bad news is actually good news for the stock market, because bad news means that the Federal Reserve can't keep raising interest rates as aggressively, because it's impacting the economy. So therefore, when we have a bad data, that means we have to be a little bit more cautious raising rates. And obviously, raising rates is a bearish factor for risk assets. So if we're more cautious and we don't have as much room to grow to the upside in terms of the rate hikes to combat inflation, well, then that leads to positive outcomes for your stock markets and negative for the U.S. dollar. So we got that sentiment for the day. As we can see over on the equity markets, we finally broke above this previous liquidity zone, the sell side liquidity zone around 3,800, and we're on our way to 3,900, which is this daily break of structure level here. So we're continuing this pullback structure as we print new higher highs, as this relief rally, this bear market rally continues. So I have to update some of my key levels here, as this now becomes a bullish level for the time being. Becomes a bullish level as we create new higher highs and consecutively have bullish candles close above this key level here. So as long as we stay above this this level, the pullback is continuing, and I was anticipating, if we break above this level, well, the next area to retest is previous lows and previous sell side liquidity zones at 3,900 here, where we could end up getting the rejections here to fade this bear market rally and create new potential lower lows, as the harsh reality of the Fed's interest rate hike cycle sets in, and the effects of this tight monetary policy has finally some effect on the markets here, as inflation is still red hot. Labor market is still like fairly strong, so there's a lot more room to go for the Fed, and the Fed has said that they're going to continue to raise rates, and they're going to keep them high for all of 2023. We're only October 2022, so keeping rates. They're going to keep raising probably another 75 basis points in November, probably another rate hike in December, potentially some smaller incremental hikes early 2023, but they're going to keep the rates high for all of 2023. So this is over 12 months. This is over a year that we're going to see the impact of this tight monetary policy across the economy. So this bullish structure from these lows here is nothing but delusion and just normal market waves as we're making our way to the upside here to create better, to create more liquidity, to generate more liquidity, to get prices back at more attractive levels so that we could continue to the downside as the fundamentals has not changed whatsoever and we are not breaking higher time frame structure. If I zoom out to the daily time frame, look how bearish the US 500 is. Right here, this small move to the upside, where it's quite significant if we're zoomed in and looking, oh, we went from 3,500 to 3,800. 300 points, 300 plus points. You know, it seems like a lot if we're zoomed in, but when we zoom out, we see that we're all the way down from 4,800. We've created consecutive lower lows, and every time we've had a pullback, come down to new lows. Even in July to September, we had a few months of pullback here. And what happened? Sellers come back in. Aggressive new lows printed. So here at this point, we're just creating a pullback, which is just normal market waves and market phases. As the next real fundamental event is in November FOMC, where we're going to be seeing, first of all, how much is the Fed going to be raising interest rates. Right now, the market consensus is 75 basis points, but even more importantly is going to be their forward guidance. Now, what are they seeing for December meeting? What are they seeing for the rest of 2023? Are they going to maintain this hawkish rhetoric? Well, right now there's a little bit of delusional hope here on our hands that is creating this pullback. But this pullback is really great for traders here, as it's setting up better prices to sell at. Like I said, 3,900 is a very key level here that we could reject. Honestly, based on the market structure, we could come up all the way to 4,150 daily supply level and still end up fading out this complete move and coming to the downside here. So we could have several months of bullish price action until we hit 2023 area, which is all the way down here, which is a few months away. And again, let me zoom out a little bit, right? I'm looking at the charts here. This is 2024. So this is the entirety. This is the entirety of 2023. Now, the Fed is saying that they're going to keep interest rates high. They're going to keep raising from November to December and potentially January, February, keep raising rates to a terminal rate of 4.5 to 5%, and then they're going to keep it high for the entirety of 2024. So do you really think, with stock markets this high, that we're going back to all-time highs throughout this period here? Or do you think this is just normal market movement, potentially grabbing some more liquidity, maybe pulling in some suckers for another great selling opportunity before the next leg down, retest the lows and potentially lower, as the entirety of 2023, as I mentioned, is going to be in restrictive territory. And if we're holding interest rates high for 2023, the entirety of 2023 to 2024, well, now we're going to start seeing the effects on the economy. Now we're going to see unemployment rate rise. We're going to see house prices fall. We're going to see continued stress on the economy and lower corporate profits. We're going to see potentially a rise in foreclosures, a rise in distressed debt, a rise in bankruptcies, as this is all necessary to keep the sky-high inflation to bring it down to the 2% target. Right? So there's a lot of of ways to go to bring inflation down, and the Fed has said over and over and over again that they are focused on bringing inflation down at any means necessary, because that is the absolute highest risk to the economy is not to have inflation under control, to see prices continue to rise. So there's no way they're going to shift and pivot into more accommodative policy because if they do that, the inflation is going to go out of control, and then the dollar's going to go to shit, and then we're going to have a depression on our hands. The Fed much prefers to have restrictive policy for 2023 and potentially see some pain and further bearish markets just to bring inflation down. Then they could start supporting the economy, as this is a normal economic cycle, as seen in 2008, as seen in 2000, as seen in the major market corrections. Right, so having said that, I am still going to adjust myself to the short-term optimistic sentiment, but I'm not going to get too attached to this as this. I'm waiting for the juicy setup of these new prices to ride the wave back down. And on US dollar, we see that we broke to the downside on this optimism, based on, again, this bad consumer confidence. We saw the break to the downside here, and now I'm going to change the structure, because now the 4 hour is entering bearish territory here, where we got new bearish structure, new 4 hour supply zone. So from these highs, we're starting to create some bearish structure, and we actually created a lower high on the higher time frames here, as we could potentially see this move on dollar continue as long as we maintain below previous candle body lows here. As long as we maintain below this structure, you can see continued sell-off on the US dollar to potentially grab some more liquidity around this weekly key level 109, where we had an accumulation of buy orders before the previous impulsive leg to the upside here. All right, so adapting to market conditions and market phases, not losing sight of the fundamental bias, but understanding that right now the dollar is weak, as we are potentially setting up better price points for November FOMC. Now, on US dollar here, it's translated to, obviously we had, based on this morning's analysis, we had mixed sentiment, so I was not even looking at the charts here, but we came to create a new lower low here. After creating these new highs, had this pullback structure that rejected, and even printing new highs, but closing below these candle bodies, closing below this daily breaker structure, showing some more indecision here, and knowing that since the overall trend is still extremely bearish, when we're entering into these pullback phases, it's quite often a lot messier, and we could have more aggressive up and down swings prior to when we jump back into the higher time frame bias. We have more clean moves here to the downside. Right? Look how messy this is compared to the next move to the downside. Look how messy this is compared to this move to the downside. This was a nice move to the upside here, but again, got faded out quite equally. And then here, we're entering another phase of pullback mode. But again, looking at 1680 as a very significant bearish price level, that we could even make it all the way back up to 1680, even 1690, and still be extremely bearish on the higher time frame. So there's no reversal, there's no this pullback is just normal market action and price setups, in my opinion, for good opportunities coming up in the very near future. Now, GU had a stronger leg up as we had a nice bullish engulfing candle closing above these previous highs, but still failing to break this overall bearish daily structure level where we had previous wicks, previous daily lows here prior to the break to the downside. So this could still get faded out here. This is not convincing enough for me to start shifting my bias out of the bears. I am keeping in mind that the US dollar is weak, and we could, if we break cleanly above these previous highs, we can see the continuation to the 1.17 price levels prior to getting potential shifts back in the market here. So I'm going to adapt to the phases in the market here as we are seeing dollar weakness, as we are seeing stock market strength. So I'm not going to rush back into the higher time frame buys, but I'm going to play some short-term potential plays on GU, as GU is looking a little bit cleaner than gold in the pullback as we're getting more aggressive upside, more controlled pullbacks, nice clean higher lows, new higher highs. As the pound has a little bit of short-term optimism as the new prime minister is set in place here. US dollar again is weak, so we're seeing more one-sided volatility as opposed to gold, which is a lot messier. So that's it. Just adapting to pullback conditions and getting ready for when the overall fundamental bias comes back into play. I got to be ready to execute.